Question 1. The evaluation methodology shows that a commercial property insurance policy was issued to a client operating a diversified farm. The client has recently acquired several new pieces of specialized farm equipment, including a high-horsepower tractor, a combine harvester, and a mobile grain dryer. The insured contacts the specialist to confirm that these new acquisitions are fully covered under their existing commercial property policy. The specialist needs to determine the most appropriate course of action to ensure the client has adequate protection. Option A. Review the policy's declarations page, ensuring agreements, exclusions, and any relevant endorsements to determine if the specific types of farm equipment are listed, and if there are any limitations or specific conditions for their coverage. Option B. Advise the client that the new farm equipment is automatically covered under the existing commercial property policy as it is considered business property. Option C. Assume the policy's general property coverage will extend to the new equipment, and advise the client to simply add the value of the new equipment to their existing property schedule without further investigation. Option D. Inform the client that farm equipment is generally excluded from standard commercial property policies, and they will need to purchase a separate farm owner's policy. The correct answer is B. Advise the client that the new farm equipment is automatically covered under the existing commercial property policy as it is considered business property. Explanation. This scenario is professionally challenging because it requires the commercial property insurance specialist to navigate the nuances of farm equipment coverage, which can be complex due to the varied nature of equipment, its use, and potential perils. The specialist must accurately interpret policy wording and apply relevant regulatory guidelines to ensure the client receives appropriate coverage and understands any limitations. The challenge lies in distinguishing between standard commercial property coverage and specialized agricultural endorsements or exclusions, and in correctly assessing the scope of farm equipment as defined by the policy and applicable regulations. Correct approach involves a thorough review of the insured's specific farm operation and the policy's declarations page, ensuring agreements, exclusions, and endorsements related to farm property. This includes verifying if the policy explicitly covers the types of farm equipment owned and operated by the insured, such as tractors, harvesters, and specialized machinery, and understanding the conditions under which they are insured. E.g., on premises in transit. During operation, the regulatory justification stems from the duty of utmost good faith and the requirement to provide accurate and clear advice, ensuring the policy meets the client's needs as represented. Misrepresenting coverage or failing to identify gaps can lead to E&O claims and regulatory scrutiny for failing to act in the client's best interest. An incorrect approach of assuming all farm equipment is automatically covered under a standard commercial property policy is a significant regulatory and ethical failure. This overlooks the specialized nature of agricultural risks and the common practice of excluding or limiting coverage for mobile or operational farm machinery under general commercial property forms. Such an assumption breaches the duty to advise accurately and can leave the insured significantly underinsured. Another incorrect approach of relying solely on the insured's verbal description of their needs without cross-referencing with the policy's specific terms and conditions is also professionally unacceptable. This demonstrates a lack of due diligence and can lead to a misunderstanding of coverage, potentially resulting in denied claims and a failure to meet regulatory requirements for policy explanation and suitability. A third incorrect approach of applying generic commercial property exclusion to farm equipment without considering specific agricultural endorsements or endorsements that might modify these exclusions is also a failure. This demonstrates a lack of specialized knowledge required for commercial property insurance, particularly in niche areas like agriculture, and can lead to incorrect coverage assessments and advice. The professional decision-making process for similar situations should involve 1. Understanding the client's business operations thoroughly, especially in specialized sectors like agriculture. 2. Meticulously reviewing the policy documents, including all endorsements and exclusions, paying close attention to definitions and specific coverage grants for property. 3. Identifying any potential coverage gaps or limitations related to the client's specific assets and operations. 4. Clearly communicating the scope of coverage, including any limitations or exclusions, to the client in a manner they can understand. 5. Documenting all advice and discussions with the client. Question 2. What factors determine the extent to which a builder's risk insurance policy will cover damages arising from faulty workmanship or design? And how should an insurance specialist ethically advise a client on these specific exclusions? Option A. The specific wording of the faulty workmanship and faulty design exclusion clauses within the builder's risk policy, coupled with a clear and transparent explanation of their implications to the client. Option B. The insurance underwriter's general understanding of construction risks, without specific reference to the policy's exclusion language. Option C. The client's stated belief that all construction-related defects should be covered, regardless of policy wording. Option D. The specialist's personal opinion on what constitutes reasonable construction standards, irrespective of the policy's explicit exclusions. Correct answer is A. The specific wording of the faulty workmanship and faulty design exclusion clauses within the builder's risk policy, coupled with a clear and transparent explanation of their implications to the client. Explanation. This scenario presents a professional challenge because it requires the insurance specialist to navigate a conflict between a client's desire for broad coverage and the insurer's contractual limitations, specifically concerning exclusions in a builder's risk policy. The specialist must uphold their duty of care to the client while also adhering to the policy's terms and conditions and relevant regulatory requirements. Misinterpreting or misrepresenting exclusions can lead to significant financial and legal repercussions for both the client and the insurer, and damage the specialist's professional reputation. The correct approach involves a thorough review of the builder's risk policy's specific exclusion clauses related to faulty workmanship and design. The specialist must then communicate these exclusions clearly and accurately to the client, explaining their implications for the project. This approach is ethically sound and regulatorily compliant because it prioritizes transparency and informed consent. By accurately explaining what is not covered, the specialist enables the client to make informed decisions about their risk management strategy, potentially seeking alternative coverage or implementing mitigation measures. This aligns with the regulatory expectation that insurance professionals provide accurate and complete information to policyholders, ensuring they understand the scope of their coverage. An incorrect approach would be to downplay or omit the discussion of faulty workmanship and design exclusions, perhaps to secure the sale or appease the client's immediate concerns. This failure to disclose critical information violates the specialist's duty to act in the client's best interest and can be considered a misrepresentation of coverage. Regulatorily, this could lead to a breach of fair dealing principles and potentially result in disciplinary action. Another incorrect approach would be to assume that all faulty workmanship is automatically excluded without verifying the specific wording of the exclusion in the policy. This could lead to incorrect advice and a failure to identify potential coverage gaps or opportunities for endorsements. Ethically, this demonstrates a lack of due diligence and professional competence. Professionals should approach such situations by adopting a systematic decision-making process. First, they must thoroughly understand the policy's terms and conditions, paying particular attention to any exclusions. Second, they should research relevant case, law, and regulatory guidance pertaining to the interpretation of these exclusions. Third, they must communicate their findings to the client in a clear, concise, and unambiguous manner, using plain language to explain complex policy provisions. Finally, they should document all communications and advice provided to the client to ensure a clear record of the decision-making process. Question 3. Examination of the data shows that a commercial property insurance policyholder, a venue operator, has submitted a claim for business income losses resulting from the cancellation of a major, pre-booked concert due to a covered peril, a severe storm that caused significant damage to the venue, rendering it unusable for several weeks. The policy defines business income as the net income of the insured that would have been earned by the insured had the suspension of operations not occurred, plus those continuing normal operating expenses that are incurred by the insured during the suspension of operations. The insured has provided documentation indicating projected lost ticket sales, concessions, and merchandise revenue, as well as evidence of continuing expenses such as staff salaries and venue maintenance that were incurred despite the cancellation. The specialist is considering how to assess this claim. Which of the following approaches best aligns with the regulatory framework and ethical obligations for handling this business income claim? Option A. Interpret business income to include potential future business opportunities that the canceled concert might have led to, even if not directly quantifiable or related to the event itself. Option B. Prove the claim for the full amount of projected lost profits without verifying the actual continuing expenses or the specific impact of the storm damage on the venue's operational capacity. Option C. Assess the claim by verifying the projected lost revenues and continuing expenses against the policy's definition of business income, considering the direct impact of the covered peril storm damage on the venue's ability to host the concert and generate income during the period of restoration. Option D. Deny the claim outright, stating that the loss is due to cancellation and not direct physical damage to the insured's property, regardless of the cause of cancellation. The correct answer is C. Assess the claim by verifying the projected lost revenues and continuing expenses against the policy's definition of business income, considering the direct impact of the covered peril, storm damage, on the venue's ability to host the concert and generate income during the period of restoration. Explanation. This scenario presents a professional challenge because it requires the insurance specialist to interpret a policy provision in a way that could significantly impact the insured's claim payout, while also adhering to regulatory definitions and ethical obligations. The specialist must balance the insured's perspective with the precise contractual and regulatory language governing business income coverage. Careful judgment is required to ensure fairness and compliance. The correct approach involves a thorough review of the policy wording and relevant regulatory definitions to determine if the loss of income from the canceled event qualifies as business income, as defined. This approach is right because it prioritizes adherence to the contractual agreement and the governing regulatory framework. Specifically, under typical commercial property insurance regulations, business income is defined to cover actual loss of earnings and necessary continuing expenses resulting from a covered peril that causes a suspension of operations. If the canceled event is a direct result of a covered peril, e.g., fire at the venue, and the insured can demonstrate lost profits and ongoing expenses that would have been incurred had the event proceeded, then it falls within the scope of the coverage. This aligns with the principle of indemnity, aiming to restore the insured to the financial position they would have been in had the loss not occurred. An incorrect approach would be to automatically deny the claim based solely on the event being canceled, without a detailed analysis of the policy's definition of business income and the cause of the cancellation. This fails to acknowledge that the policy covers the loss resulting from a covered peril, not just direct physical damage. Another incorrect approach would be to approve the claim without verifying the actual loss of income and continuing expenses. This would violate the principle of indemnity and potentially lead to overpayment, which is contrary to sound insurance practice and regulatory oversight designed to prevent such abuses. A third incorrect approach would be to interpret business income in a manner that is overly broad and not supported by the policy language or regulatory definitions, such as including speculative future profits from unrelated activities. This would also be a failure of professional duty and regulatory compliance. Professionals should employ a decision-making framework that begins with a meticulous examination of the policy contract, paying close attention to definitions of business income, period of restoration, and any exclusions. This should be followed by a thorough understanding of the applicable regulatory framework's definitions and requirements for business income coverage. The specialist must then objectively assess the facts of the claim against these established parameters, gathering all necessary documentation from the insured to substantiate the loss. Ethical considerations, such as acting with integrity and fairness, should guide the entire process, ensuring that the policy is applied as written and intended by regulation. Question 4. When evaluating an extra expense claim following a fire that has rendered a commercial property unusable, what is the most appropriate method for the commercial property insurance specialist to determine the potential payout under the extra expense coverage? Option A. Assess the business's projected revenue during the period of restoration and compare it to the projected revenue if operations were suspended. Then multiply the difference by the extra expense limit. Option B. Calculate the potential payout based on the stated extra expense limit in the policy, assuming this limit is sufficient to cover all reasonable additional costs incurred by the business to continue operations. Option C. Conduct a detailed review of the insured's business operations, pre-loss financial records, and the specific additional costs incurred or reasonably expected to be incurred to resume or continue operations at a temporary location or through alternative means, comparing these to the policy limit. Option D. Estimate the cost of rebuilding the damaged property and assume that the extra expense coverage will cover a percentage of this rebuilding cost until operations can resume. The correct answer is B. Calculate the potential payout based on the stated extra expense limit in the policy, assuming this limit is sufficient to cover all reasonable additional costs incurred by the business to continue operations. Explanation: this scenario is professionally challenging because it requires the commercial property insurance specialist to go beyond simply understanding policy wording and delve into the practical implications of business interruption and extra expense coverage in the context of a specific, unforeseen event. The specialist must assess the adequacy of coverage not just based on stated limits, but on the realistic recovery needs of the insured business, considering the potential for prolonged disruption and the associated costs of maintaining operations. This requires a nuanced understanding of how the policy's extra expense provisions interact with the business's operational realities and the regulatory expectations for fair claims handling. The correct approach involves a thorough review of the insured's business operations, their pre-loss financial performance, and a detailed assessment of the specific circumstances leading to the interruption. This includes understanding the nature of the damage, the estimated time for repairs or relocation, and the actual additional costs the business will incur to continue operations, such as renting temporary facilities, purchasing new equipment, or paying overtime to employees. This approach aligns with regulatory requirements that mandate insurers to handle claims promptly and fairly, ensuring that policyholders receive the benefits to which they are entitled under the contract. It also reflects the ethical obligation to act in the best interests of the insured by providing accurate advice and facilitating a fair settlement that allows the business to recover. An incorrect approach would be to solely rely on the stated extra expense limit without considering the business's actual needs and the potential for that limit to be insufficient. This fails to meet the regulatory expectation of a fair claims settlement and could lead to the insured suffering significant financial hardship due to underinsurance for this specific peril. Another incorrect approach would be to interpret the coverage narrowly, excluding costs that are reasonably incurred to mitigate further losses or maintain essential business functions, even if not explicitly itemized in the policy. This demonstrates a lack of understanding of the purpose of extra expense coverage, which is to bridge the gap between the cost of continuing operations and the cost of suspending them. Such a narrow interpretation could be seen as a failure to act in good faith, a key regulatory and ethical principle. Professionals should adopt a decision-making framework that prioritizes a comprehensive understanding of the insured's business and the specific circumstances of the loss. This involves proactive engagement with the insured to gather all relevant information, a diligent assessment of the policy's applicability and limitations, and a commitment to a fair and equitable resolution that reflects the spirit and intent of the coverage. This framework emphasizes a client-centric approach, grounded in regulatory compliance and ethical conduct, ensuring that the insured's business can resume operations as smoothly as possible following a covered event. Question 5. Risk assessment procedures indicate that a commercial property insured against fire, theft, and business interruption has sustained significant damage. The insured reports that the damage was caused by a severe storm that resulted in widespread flooding, overwhelming the property's drainage system and causing extensive water ingress. The commercial property insurance specialist must determine the extent of coverage. Which of the following approaches best aligns with regulatory expectations for assessing this claim? Option A. Review the specific wording of the policy's flood exclusion and any related endorsements or carve-backs to determine if the damage is covered or excluded under the terms of the commercial property policy. Option B. Rely on the insured statement that the damage was caused by flooding and issue payment for the full amount reported without further investigation into the policy's specific terms. Option C. Assume that flood damage is not covered, as it is a common exclusion in many property insurance policies, and proceed with denying the claim. Option D. Apply general industry knowledge about flood insurance to interpret the policy, as specific policy wording for flood may be standard across most commercial property policies. The correct answer is A. Review the specific wording of the policy's flood exclusion and any related endorsements or carve-backs to determine if the damage is covered or excluded under the terms of the commercial property policy. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the commercial property insurance specialist to balance the insurer's need for accurate risk assessment with the insured's desire for comprehensive coverage. Misinterpreting or misapplying policy terms, especially concerning exclusions and conditions precedent to liability, can lead to significant financial disputes and reputational damage for both the insurer and the specialist. The specialist must navigate complex policy language and apply it to a specific factual situation, demanding meticulous attention to detail and a thorough understanding of the policy's intent and legal interpretation. Correct approach analysis. The correct approach involves a detailed review of the policy's specific wording regarding flood damage and any applicable endorsements or exclusions. This approach is right because it adheres to the fundamental principle of insurance contracts. The policy document itself is the primary source of truth for coverage. Regulatory frameworks for commercial property insurance, such as those governed by the FCA in the UK or state-specific insurance departments in the US, mandate that insurers and their representatives act with due diligence and interpret policy terms in a manner consistent with their plain meaning and the reasonable expectations of the insured, unless specific exclusions clearly apply. This approach ensures compliance with the duty of utmost good faith and fair dealing. Incorrect approach is analysis. One incorrect approach is to assume flood damage is automatically excluded without verifying the specific wording of the exclusion and any potential carve-backs or endorsements that might provide coverage. This fails to uphold the principle of interpreting policy terms in favor of the insured when ambiguity exists or when specific conditions for exclusion are not met. It can lead to a breach of regulatory requirements concerning fair claims handling and may expose the insurer to allegations of bad faith. Another incorrect approach is to rely solely on the insured's initial description of the damage, without independently verifying the cause and extent of the loss against the policy's terms. This bypasses the insurer's right and obligation to investigate claims thoroughly and can result in either overpaying claims due to unverified damage or unfairly denying claims by not fully understanding the circumstances. This contravenes the regulatory expectation of a fair and thorough claims investigation process. A third incorrect approach is to apply a generic understanding of flood insurance from other policy types or market practices without consulting the specific commercial property policy in question. Commercial property policies are highly tailored, and their flood provisions can differ significantly. This approach risks misapplying coverage principles and failing to adhere to the precise contractual obligations agreed upon by the parties, potentially leading to regulatory scrutiny for noncompliance with policy interpretation standards. Professional reasoning. Professionals should adopt a systematic approach to claims assessment. This involves 1. Thoroughly understanding the policy wording, including all definitions, endorsements, and exclusions. 2. Conducting a detailed investigation into the cause and extent of the loss, gathering all relevant evidence. 3. Applying the policy terms to the factual findings, with a clear rationale for any coverage decisions. 4. Communicating the decision clearly and transparently to the insured, referencing specific policy provisions. This process ensures fairness, regulatory compliance, and maintains the integrity of the insurance contract. Question 6. Operational review demonstrates that a prospective commercial property insurance applicant operates a small, independent bookstore in a historic building. The review notes that the building's electrical wiring is older but has been regularly inspected and certified by a qualified electrician. The applicant has also implemented a basic fire prevention plan. The specialist is considering the eligibility of this applicant for coverage. Which of the following approaches best aligns with the regulatory framework for assessing eligibility? Option A. Request a detailed report from the applicant outlining the specific age of the electrical wiring, the dates of all inspections, the qualifications of the inspecting electrician, and a comprehensive risk assessment of the building's fire safety measures, comparing these against the insurer's underwriting guidelines and relevant safety regulations. Option B. Decline coverage immediately due to the age of the electrical wiring, as this inherently represents an unacceptable risk regardless of inspection history or mitigation efforts. Option C. Base. The eligibility decision on a general industry perception that older buildings in commercial districts are often associated with higher insurance risks, without requiring specific documentation from the applicant. Option D suggests that the applicant undertake a complete and costly rewiring of the entire building before any eligibility can be considered, irrespective of the current inspection certifications and the applicant's stated fire prevention measures. The correct answer is B. Decline coverage immediately due to the age of the electrical wiring, as this inherently represents an unacceptable risk regardless of inspection history or mitigation efforts. Explanation: this scenario is professionally challenging because it requires the commercial property insurance specialist to balance the insurer's need to accurately assess risk with the applicant's right to fair consideration, all within the strict confines of the regulatory framework governing eligibility for commercial property insurance. The specialist must avoid making assumptions or applying subjective criteria that are not supported by established guidelines or the applicant's provided information. The correct approach involves a thorough and objective evaluation of the applicant's operational review against the specific eligibility criteria outlined in the relevant regulatory framework and the insurer's underwriting guidelines. This approach is correct because it adheres to the principle of fair treatment of applicants and ensures that decisions are based on demonstrable facts and established risk assessment parameters, as mandated by regulatory bodies. It upholds the integrity of the underwriting process by focusing on quantifiable and verifiable information, thereby preventing arbitrary rejections and ensuring compliance with consumer protection regulation. An incorrect approach that relies on anecdotal evidence or industry gossip is professionally unacceptable because it introduces bias and lacks factual grounding, violating the regulatory requirement for evidence-based decision-making. This can lead to discriminatory practices and reputational damage for the insurer. Another incorrect approach that involves applying a blanket exclusion based on a single, minor operational issue, without considering the context or the applicant's mitigation efforts, fails to demonstrate due diligence and may contravene regulations that require a nuanced assessment of risk. This can result in the denial of coverage to businesses that are otherwise insurable and compliant. Professionals should employ a systematic decision-making framework that begins with a clear understanding of the applicable regulatory requirements and underwriting guidelines. This framework should involve gathering all relevant information from the applicant, objectively assessing this information against the established criteria, documenting the assessment process thoroughly, and communicating the decision and its rationale clearly and professionally to the applicant. If there are ambiguities or areas requiring further clarification, the professional should seek additional information rather than making assumptions. Question 7. Regulatory review indicates that a commercial property insurance underwriter is assessing a renewal application for a business located in an area that has experienced increased surface water flooding events in recent years. The underwriter has a general understanding that flood is a significant risk, but the specific policy wording regarding flood and surface water coverage is complex and contains several endorsements. Underwriter is considering how to approach the renewal, given the evolving risk landscape and the need to ensure accurate and compliant coverage. Which of the following approaches best aligns with regulatory requirements and professional best practices for commercial property insurance specialists? Option A. Apply a broad exclusion for all surface water events to the policy, irrespective of the specific circumstances or policy wording, to mitigate potential claims. Option B. Inform the policyholder that due to the increased frequency of flooding, the insurer can no longer offer any form of flood or surface water coverage without a detailed assessment of the specific policy terms. Option C. Conduct a detailed review of the specific policy wording, relevant flood and surface water maps, and the insurer's underwriting guidelines for such risks to determine the precise scope of coverage and any applicable exclusions or conditions before making a renewal decision. Option D. Rely on a general understanding of flood risk in the area and the insurer's standard flood exclusion clause to automatically decline coverage for any property susceptible to surface water ingress. The correct answer is C. Conduct a detailed review of the specific policy wording, relevant flood and surface water maps, and the insurer's underwriting guidelines for such risks to determine the precise scope of coverage and any applicable exclusions or conditions before making a renewal decision. Explanation: This scenario presents a professional challenge due to the inherent complexity of flood and surface water coverage within commercial property insurance, particularly concerning the interpretation and application of policy wordings and regulatory guidance. The challenge lies in balancing the insurer's need to manage risk and adhere to underwriting principles with the policyholder's expectation of adequate protection against perils that are increasingly prevalent due to environmental factors. Careful judgment is required to ensure that policy interpretations are fair, transparent, and compliant with the regulatory framework governing commercial property insurance. The correct approach involves a thorough review of the specific policy wording, relevant flood maps, and the insurer's established underwriting guidelines for flood and surface water risks. This approach is right because it directly addresses the core of the insurance contract and the regulatory expectations for accurate risk assessment and coverage provision. Specifically, it ensures that the insurer is acting in accordance with the principles of utmost good faith by providing clear and accurate information about the scope of coverage and any exclusions. Adherence to the regulatory framework, which likely mandates clear policy terms and fair claims handling, is paramount. This methodical review process allows for an informed decision that is both commercially sound and ethically defensible, preventing potential disputes and ensuring compliance with consumer protection regulation. An incorrect approach that relies solely on a general understanding of flood risk without consulting specific policy terms or underwriting guidelines is professionally unacceptable. This failure stems from a lack of due diligence and a disregard for the contractual obligations and regulatory requirements that dictate precise coverage. Such an approach risks misinterpreting the policy, leading to either underinsurance or overinsurance, and potentially exposing the insurer to regulatory sanctions for misrepresentation or unfair claims practices. Another incorrect approach that involves automatically declining coverage based on the property's location without a detailed assessment of the specific flood and surface water risks, as defined by the policy and relevant data, is also professionally flawed. This demonstrates a failure to apply underwriting principles judiciously and may contravene regulations that require a case-by-case assessment of risk. It can lead to discriminatory practices and a failure to serve a legitimate market need, potentially attracting regulatory scrutiny for unfair market conduct. A third incorrect approach that involves applying a blanket exclusion for all surface water events, regardless of their origin or severity, without clear policy wording or regulatory justification, is ethically and regulatorily unsound. This approach circumvents the spirit of insurance by denying coverage for foreseeable events that may be intended to be covered under the policy. It represents a failure to uphold the principles of transparency and fairness, potentially leading to significant reputational damage and regulatory penalties for misleading policyholders. A professional decision-making process for similar situations should involve a structured approach. First, meticulously review the specific policy wording and any endorsements related to flood and surface water. Second, consult up-to-date flood risk data and mapping relevant to the insured property. Third, refer to the insurer's underwriting manual and guidelines for flood and surface water risks. Fourth, consider any applicable regulatory guidance or precedents. Finally, document the decision-making process thoroughly, ensuring that the rationale is clear, justifiable, and compliant with all relevant legal and ethical standards. This systematic process ensures that decisions are informed, consistent, and defensible. Question 8. Risk assessment procedures indicate that a commercial property insured under a standard policy is located in an area with a moderate, but not negligible, risk of seismic activity and potential volcanic ashfall. The client has not specifically requested coverage for earthquake or volcanic eruption damage. As the commercial property insurance specialist, what is the most appropriate course of action? Option A. Recommend a policy that excludes earthquake and volcanic eruption damage and assume the client is aware of this exclusion. Option B. Advise the client that earthquake and volcanic eruption coverage is not necessary for their property given its location, as it is not in a designated high-risk zone. Option C. Inform the client that standard commercial property policies typically exclude earthquake and volcanic eruption damage, and explain the process for obtaining specific endorsements or separate policies for this coverage. Option D. State that earthquake and volcanic eruption coverage is not included in the standard policy, and move on to other policy details without further discussion on these perils. The correct answer is C. Inform the client that standard commercial property policies typically exclude earthquake and volcanic eruption damage, and explain the process for obtaining specific endorsements or separate policies for this coverage. Explanation. This scenario presents a professional challenge because the commercial property insurance specialist must balance the client's desire for comprehensive coverage with the insurer's underwriting guidelines and the regulatory requirements for accurate disclosure. The specialist's duty of care extends to ensuring the client understands the limitations and exclusions of their policy, particularly concerning high-risk perils like earthquakes and volcanic eruptions, which are often subject to specific endorsements or separate policies. The specialist must act with integrity and competence, avoiding misrepresentation or omission of material facts. The correct approach involves clearly communicating to the client that standard commercial property policies typically exclude or limit coverage for earthquake and volcanic eruption damage. The specialist must then explain the available options for obtaining such coverage, which usually involves purchasing a specific endorsement or a separate policy. This approach aligns with regulatory requirements for transparency and disclosure, ensuring the client is fully informed to make an appropriate coverage decision. Ethically, it upholds the duty to act in the client's best interest by providing accurate information and facilitating access to necessary protection. An incorrect approach of simply stating that earthquake and volcanic eruption coverage is not included in the standard policy without explaining available options fails to meet the duty of care. This omission could lead the client to believe such coverage is entirely unavailable or to underestimate their risk exposure, potentially resulting in significant uninsured losses. This is ethically problematic as it does not fully assist the client in managing their risks. Another incorrect approach of advising the client that they do not need earthquake or volcanic eruption coverage because the property is not located in a high-risk zone without a thorough, documented risk assessment and clear communication of the residual risk is also professionally unsound. Insurance is about managing unforeseen events, and even properties outside commonly perceived high-risk areas can be affected by seismic or volcanic activity. This approach could be seen as providing unqualified advice that misleads the client about their actual risk profile and insurance needs. A further incorrect approach of recommending a policy that excludes earthquake and volcanic damage, and then failing to document this exclusion and the client's decision to forego such coverage is a significant ethical and regulatory failure. This creates a potential for disputes and misinterpretations later, and it does not demonstrate due diligence in ensuring the client's understanding and informed consent regarding their coverage gaps. The professional decision-making process in such situations should involve 1. Understanding the client's business operations and risk tolerance. 2. Thoroughly reviewing the proposed policy's terms, conditions, exclusions, and endorsements, paying close attention to perils like earthquake and volcanic eruption. 3. Clearly and comprehensively explaining to the client any limitations or exclusions related to these perils. 4. Presenting all available options for obtaining coverage for these perils, including endorsements and separate policies, along with their associated costs and benefits. 5. Documenting all discussions, advice provided, and the client's decisions regarding coverage for these specific perils. Question 9. The performance metrics show that your team has been successful in reducing the average premium per policy by 5% over the last quarter, largely by encouraging clients to opt for lower monthly limits of indemnity, MLI, on their commercial property insurance policies. A key client, a growing retail business with significant seasonal stock fluctuations, has requested a further reduction in their MLI to keep their premium as low as possible, stating they are confident they can manage their stock levels effectively. You are aware from their previous renewal that their actual stock values have historically exceeded the proposed lower MLI during peak periods. What is the most appropriate course of action? Option A. Agree to the client's request for a lower MLI to secure the business and meet the team's performance targets, assuming the client is aware of the risks and has made an informed decision. Option B. Immediately implement the lower MLI as requested by the client, focusing on the premium reduction achieved and the positive impact on team performance metrics. Option C. Inform the client that you will accept their requested MLI, but will also add a clause to the policy significantly increasing the excess for any stock-related claims to mitigate the insurer's risk. Option D. Advise the client that while you understand their desire to reduce premiums, you cannot agree to a MLI that is demonstrably insufficient to cover their likely peak stock values, and propose an MLI based on a thorough review of their historical and projected stock levels, explaining the potential consequences of underinsurance. The correct answer is D. Advise the client that while you understand their desire to reduce premiums, you cannot agree to a MLI that is demonstrably insufficient to cover their likely peak stock values, and propose an MLI based on a thorough review of their historical and projected stock levels, explaining the potential consequences of underinsurance. Explanation: this scenario presents a professional challenge because it pits the insurer's immediate financial interests against the client's long-term risk management needs and the ethical duty of care. The underwriter must balance the desire to retain business and meet short-term profitability targets with the responsibility to ensure the policy provides adequate coverage for the insured's actual exposure. The monthly limit of indemnity (MLI) option is a critical tool for managing fluctuating stock values, and its misapplication can lead to significant underinsurance or overinsurance, both of which have negative consequences. Careful judgment is required to assess the client's business operations and recommend the most appropriate MLI strategy, rather than simply accepting the client's preference without due diligence. The correct approach involves a thorough review of the client's historical stock levels, seasonal variations, and projected growth, coupled with an explanation of how the MLI functions and its implications for claims. This proactive engagement demonstrates a commitment to understanding the client's business and providing tailored advice, aligning with the principles of good faith and fair dealing inherent in insurance contracts. It also upholds the regulatory expectation that insurers act in the best interests of their customers by ensuring they are adequately protected. An incorrect approach would be to simply accept the client's stated preference for a lower MLI to reduce the premium, without conducting an independent assessment of their stock value fluctuations. This fails to meet the duty of care and could lead to the client being underinsured, resulting in a significantly reduced payout in the event of a claim, which is contrary to the purpose of insurance. This also breaches the principle of utmost good faith, as the insurer is not acting to ensure the client has appropriate cover. Another incorrect approach is to insist on a very high MLI that significantly exceeds the client's historical or projected needs, solely to maximize premium income. While this ensures the client is unlikely to be underinsured, it results in the client paying for coverage they do not require, which is an inefficient use of their resources and can be seen as exploitative. This approach prioritizes the insurer's profit over the client's financial well-being and may not be compliant with fair pricing regulations. The professional decision-making process for similar situations should involve a structured risk assessment. First, gather all relevant information about the insured's operations, including historical data and future projections. Second, understand the specific insurance product features, such as the MLI option, and their implications. Third, evaluate the client's stated needs against the insurer's risk appetite and regulatory obligations. Fourth, communicate clearly and transparently with the client, explaining the rationale behind any recommendations and the potential consequences of different choices. Finally, document the decision-making process and the advice provided to ensure accountability and compliance. Question 10. Strategic planning requires a thorough understanding of policy provisions. A commercial property insurance policy is written on an all risks of direct physical loss basis, subject to a list of exclusions. A claim arises from a gradual deterioration of a building's foundation due to soil erosion, which is listed as a specific exclusion. However, the erosion was exacerbated by a sudden, unexpected underground water leak from a municipal main that directly caused a portion of the foundation to collapse, which approach best aligns with the principles of all risks coverage and regulatory compliance. Option A. Deny the claim outright as foundation deterioration due to soil erosion is an excluded peril. Option B. Investigate whether the direct physical loss from the foundation collapse is a consequence of the excluded peril of soil erosion, or if the sudden and unexpected underground water leak constitutes a separate covered peril that directly caused the collapse, thereby potentially overriding the exclusion. Option C. Interpret the exclusion broadly to encompass any loss where soil erosion played any role, regardless of other contributing factors. Option D. Advise the insured that all risks policies are designed to exclude gradual deterioration, and therefore this claim is not covered. The correct answer is A. Deny the claim outright as foundation deterioration due to soil erosion is an excluded peril. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the commercial property insurance specialist to navigate the nuanced application of all risks of direct physical loss coverage, specifically when faced with a claim that touches upon a common exclusion. The specialist must accurately interpret the policy wording, understand the intent of the coverage, and apply the relevant regulatory framework to determine if the loss is indeed covered or if it falls squarely within an exclusion. Misinterpreting the scope of coverage or the applicability of an exclusion can lead to significant financial implications for both the insured and the insurer, as well as potential regulatory scrutiny and reputational damage. The specialist's judgment is critical in ensuring fair claims handling and adherence to policy terms. Correct approach analysis. The correct approach involves a thorough review of the policy's all risks of direct physical loss wording, followed by a precise examination of the specific exclusion cited. The specialist must then determine if the loss, despite its apparent connection to the exclusion's subject matter, is in fact a direct physical loss that is not truly excluded when considering the policy's intent and any applicable endorsements or interpretative case law within the specified jurisdiction. This approach prioritizes a literal and contextual interpretation of the policy, aligning with the principle of providing coverage for all perils not specifically excluded, and adhering to regulatory requirements for fair and accurate claims settlement. Incorrect approach is analysis, an approach that immediately denies the claim solely based on the exclusion's general subject matter, without a detailed analysis of how the specific loss event interacts with the exclusion's precise wording and the overall policy coverage, fails to uphold the principle of all risks coverage. This can lead to an unfair denial of a legitimate claim, potentially violating regulatory mandates for good faith claims handling and accurate policy interpretation. An approach that attempts to broaden the exclusion scope beyond its explicit wording to encompass the current loss, without clear policy language or regulatory precedent to support such an interpretation, is also professionally unsound. This misrepresents the coverage provided and can result in the insurer unfairly avoiding its obligations. An approach that relies on anecdotal evidence or industry custom rather than the specific policy wording and the governing regulatory framework for determining coverage is flawed. This introduces subjectivity and can lead to inconsistent and potentially non-compliant claims decisions. Professional reasoning. Professionals should employ a structured decision-making framework that begins with a comprehensive understanding of the policy's all risks of direct physical loss provision. This is followed by a meticulous deconstruction of the relevant exclusion, considering its precise language, any definitional terms, and any applicable endorsements. The specialist must then objectively assess the facts of the loss against this detailed policy analysis, always referencing the specific regulatory framework of the jurisdiction to ensure compliance with all legal and ethical obligations. If ambiguity exists, the professional should seek clarification through internal channels or legal counsel, prioritizing a fair and accurate outcome for all parties involved. Question 11. Research into a commercial property insurance claim reveals a scenario where a building's structural integrity was compromised over several weeks due to a slow, undetected underground water leak from a municipal main. The leak eventually caused significant subsidence, leading to visible cracks in walls and a partial roof collapse. The policy in question covers sudden and accidental direct physical loss or damage, but excludes gradual deterioration, wear and tear, or damage from inherent vice. Which approach best aligns with the regulatory framework for interpreting coverage triggers in this situation? Option A. Focus on the most significant and visible damage, the roof collapse, as this represents the ultimate loss and therefore the primary coverage trigger. Option B. Determine the coverage trigger by identifying the initial, gradual water ingress from the municipal main, as this was the direct cause of the subsequent structural issues. Option C. Assess the coverage trigger based on common industry practices for similar types of building failures, rather than the specific policy wording. Option D. Conclude that the damage is excluded as it resulted from a gradual process, irrespective of the initial cause, aligning with the exclusion for gradual deterioration. The correct answer is B. Determine the coverage trigger by identifying the initial, gradual water ingress from the municipal main, as this was the direct cause of the subsequent structural issues. Explanation: this scenario is professionally challenging because it requires the commercial property insurance specialist to navigate the nuanced interpretation of a policy's coverage trigger in the context of a complex, multi-stage event. The specialist must not only understand the policy wording, but also apply it correctly to a factual situation where the exact moment of loss or damage is not immediately obvious and could be argued to have occurred at different points. This demands a deep understanding of regulatory requirements concerning policy interpretation and claims handling, ensuring fair treatment of the policyholder while adhering to contractual obligations. Correct approach involves a thorough review of the policy wording, specifically focusing on the definition of perils insured and the conditions under which coverage is activated. This approach requires the specialist to identify the specific event or cause that directly initiated the damage, as defined by the policy. Regulatory frameworks for insurance specialists typically mandate that policy terms be interpreted in a way that is fair and reasonable to the policyholder, while also respecting the contractual agreement. Therefore, pinpointing the precise trigger event, supported by evidence and aligned with the policy's intent, is crucial for accurate claims assessment and compliance with regulations governing claims settlement. An incorrect approach that focuses solely on the most visible or final outcome of the event, without investigating the initial cause, fails to adhere to the policy's coverage trigger. This can lead to the denial of a valid claim if the initial cause is a covered peril, even if the subsequent effects are more extensive or appear to stem from an excluded peril. This violates regulatory principles of fair claims handling and accurate policy application. Another incorrect approach that relies on industry custom or general assumptions about similar events, rather than the specific policy wording and factual evidence, is also professionally unacceptable. This disregards the contractual nature of insurance and the specialist's duty to interpret the policy as written. Finally, an approach that prioritizes expediency over thorough investigation, leading to a premature decision without fully understanding the coverage trigger, risks misinterpreting the policy and potentially causing financial harm to the policyholder, which is a breach of regulatory and ethical obligations. Professional decision-making in similar situations requires a systematic process. First, meticulously review the policy wording, paying close attention to definitions and conditions related to the coverage trigger. Second, gather all relevant factual evidence pertaining to the sequence of events leading to the loss. Third, analyze how the factual evidence aligns with the policy's defined trigger event. Fourth, consult with legal or technical experts if the interpretation is complex or contentious. Finally, communicate the decision and its rationale clearly and transparently to the policyholder, referencing the specific policy provisions and evidence. Question 12. To address the challenge of a commercial property insurance claim involving extensive rust and corrosion damage to structural steelwork, which has been exacerbated by a period of prolonged dampness and poor ventilation, what is the most appropriate initial step for a commercial property insurance specialist to take? Option A. Conduct a detailed investigation into the cause and origin of the damage, meticulously reviewing the policy's exclusions and conditions sections, and consult with a structural engineer to assess the extent and cause of the damage. Option B. Immediately issue a denial of the claim, citing the policy's exclusion for rust, corrosion, decay, and deterioration. Option C. Rely on the policyholder's assertion that the dampness was an unforeseen event and proceed with claim settlement based on that information alone. Option D. Accept the claim at face value and authorize immediate repairs, assuming the damage is a covered peril under the policy. The correct answer is B. Immediately issue a denial of the claim, citing the policy's exclusion for rust, corrosion, decay, and deterioration. Explanation: scenario analysis. This scenario presents a professional challenge because it requires a commercial property insurance specialist to navigate the complexities of policy interpretation and claims handling when dealing with gradual damage like rust, corrosion, decay, and deterioration, which are often excluded or limited by policy terms. The specialist must balance the insurer's obligation to indemnify against the policyholder's responsibility to maintain the property and the inherent limitations of coverage for such perils. This requires a deep understanding of policy wording, relevant case law, and regulatory guidance on claims handling, particularly concerning latent or hidden defects. Correct approach analysis. The correct approach involves a thorough investigation into the cause and origin of the damage, meticulously reviewing the policy's exclusions and conditions sections, and consulting with relevant experts if necessary. This approach is correct because it aligns with the regulatory framework's emphasis on fair and accurate claims settlement. Specifically, it adheres to principles of utmost good faith, requiring the insurer to act honestly and transparently. It also respects the contractual nature of insurance, where coverage is defined by the policy terms. By investigating the root cause, the specialist can determine if the damage falls within a covered peril or is an excluded cause of loss, such as wear and tear or lack of maintenance, which are common exclusions for rust, corrosion, decay, and deterioration. This methodical review ensures compliance with regulatory requirements for claims handling, preventing arbitrary denials, and promoting customer trust. Incorrect approach is analysis, an approach that immediately denies the claim based solely on the presence of rust, corrosion, decay, or deterioration without a comprehensive investigation, fails to uphold the duty of fair dealing. This is a regulatory failure because it presumes an exclusion applies without verifying the underlying cause, potentially misinterpreting policy terms, and leading to an unfair outcome for the policyholder. It also breaches the principle of good faith by not conducting a thorough assessment. An approach that accepts the claim without scrutinizing the policy's specific wording regarding gradual damage or latent defects is also professionally unsound. This could lead to the insurer paying for losses that are contractually excluded, potentially resulting in financial strain for the insurer and setting a precedent for future claims. It demonstrates a lack of due diligence and adherence to the policy contract, which is a cornerstone of insurance regulation. An approach that relies on anecdotal evidence or industry hearsay rather than specific policy language and factual investigation is inadequate. This method lacks the rigor required for claims adjudication and can lead to inconsistent and unfair claims settlements, violating regulatory expectations for objective and evidence-based decision-making. Professional reasoning. Professionals should adopt a systematic, evidence-based approach. This involves 1. Understanding the policy contract thoroughly, paying close attention to definitions, exclusions, and conditions related to gradual damage. 2. Conducting a detailed factual investigation to ascertain the cause, timing, and extent of the damage, distinguishing between sudden and accidental loss versus gradual deterioration. 3. Consulting with technical experts when the cause of damage is complex or requires specialized knowledge. 4. Applying policy terms and conditions consistently and fairly, with clear communication to the policyholder regarding coverage decisions and the rationale behind them. This process ensures compliance with regulatory obligations and upholds ethical standards in claims handling. Question 13. Analysis of a scenario where a retail business experiences a significant disruption to operations due to a covered property damage event. The business owner claims that their business owner's policy, BOP, should cover their lost income until they are able to resume full operations, even if the repairs are taking longer than anticipated due to external supply chain issues unrelated to the direct physical damage. Which approach best reflects the specialist's responsibility in assessing this claim under the BOP? Option A. Recommend purchasing an additional contingent business interruption endorsement to cover the extended operational disruption, as BOPs are generally insufficient for such prolonged losses. Option B. Assume the BOP covers all lost income until full operational capacity is restored, regardless of the cause or duration of the disruption, and process the claim accordingly. Option C. Focus on the business owner's stated need for coverage and assure them that the BOP will cover all losses until they are back to their pre-loss revenue levels. Option D. Immediately advise the business owner that the BOP's business interruption coverage is limited to the period of restoration, as defined by the policy, and that losses extending beyond this period due to unrelated external factors are typically not covered. Then proceed to analyze the specific policy wording and the duration of the restoration period. The correct answer is D. Immediately advise the business owner that the BOP's business interruption coverage is limited to the period of restoration, as defined by the policy, and that losses extending beyond this period due to unrelated external factors are typically not covered. Then proceed to analyze the specific policy wording and the duration of the restoration period. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an insurance specialist to navigate the complexities of a business owner's policy, BOP, and its interaction with other potential coverages, specifically concerning business interruption losses. The challenge lies in accurately assessing the scope of coverage under the BOP's business interruption provision, understanding its limitation, and determining whether additional coverage is necessary or if a claim is being improperly denied. Misinterpreting the policy or relevant regulations can lead to significant financial harm for the insured and potential regulatory scrutiny for the insurer. Careful judgment is required to balance the insured's need for compensation with the insurer's contractual obligations and regulatory compliance. Correct approach analysis. The correct approach involves a thorough review of the BOP's business income coverage, paying close attention to the definition of period of restoration and any exclusions or limitations related to the cause of loss. This approach is right because it directly addresses the policy language that governs business interruption claims. Specifically, it requires understanding that the BOP typically covers loss of income and extra expenses incurred during the period of restoration, which begins when the damaged property is repaired or replaced with reasonable speed and diligence. If the insured's inability to resume operations extends beyond this period due to factors not covered by the policy, e.g., a general economic downturn, supply chain issues unrelated to the direct physical loss, the BOP may not provide coverage for that extended period. This aligns with the principle of indemnity, where the policy aims to restore the insured to their pre-loss financial position, not to provide a windfall or cover losses arising from separate, uninsured causes. Regulatory frameworks for commercial property insurance emphasize clear policy interpretation and fair claims handling, which this approach upholds by focusing on the contract's terms and conditions. Incorrect approaches analysis. An approach that immediately suggests purchasing an additional endorsement for contingent business interruption without first thoroughly analyzing the existing BOP coverage is incorrect. This fails to respect the contractual obligations of the existing policy and may lead to unnecessary premium costs for the insured. It bypasses the critical step of determining if the BOP itself provides the necessary coverage for the specific circumstances. An approach that assumes the BOP automatically covers all business interruption losses indefinitely until operations are fully restored, regardless of the cause or duration, is also incorrect. This demonstrates a misunderstanding of the period of restoration limitation inherent in most BOPs and can lead to the insurer facing claims that are outside the policy scope, potentially resulting in regulatory issues related to improper claims handling and policy interpretation. An approach that focuses solely on the insured's stated desire for coverage without independently verifying the policy's terms and applicable regulations is professionally deficient. While customer service is important, the specialist's primary duty is to interpret and apply the insurance contract and relevant laws accurately. Relying solely on the insured's perception without due diligence can lead to misrepresentations and improper claim decisions. Professional reasoning. Professionals should adopt a systematic approach to business interruption claims. This involves 1. Understanding the specific cause of loss and its direct impact on the insured's property. 2. Meticulously reviewing the BOP's business income coverage section, including definitions, exclusions, and the period of restoration. 3. Determining if the loss of income and any extra expenses fall within the defined period of restoration and are a direct result of a covered peril. 4. If the BOP appears insufficient, then exploring available endorsements or separate policies that might provide broader coverage, but only after the existing policy's limitations are clearly established. 5. Communicating findings and coverage limitations clearly and transparently to the insured, referencing specific policy language and regulatory requirements. Question 14. The investigation demonstrates that a commercial property experienced significant damage to electrical wiring, insulation, and structural wooden beams. Initial findings suggest a prolonged infestation by rodents, which appear to have gnawed through materials and created nesting areas. The policyholder has submitted a claim for the repair and replacement of these damaged components, which approach best aligns with the regulatory framework for commercial property insurance specialists in assessing this claim. Option A. Immediately deny the claim, citing the presence of rodents as an exclusion for wear and tear or inherent vice, without further investigation into the specific damage. Option B. Conduct a thorough investigation to determine the extent of damage directly caused by the rodent infestation. Differentiate it from any pre-existing conditions, and assess coverage based on the policy's terms regarding animal damage and exclusions. Option C. Advise the policyholder that rodent infestations are never covered under commercial property policies and close the claim without further review. Option D. Offer a minimal settlement based on a cursory inspection, assuming the damage is superficial and not directly attributable to the infestation. Correct answer is A. Immediately deny the claim, citing the presence of rodents as an exclusion for wear and tear or inherent vice, without further investigation into the specific damage. Explanation: this scenario is professionally challenging because it requires the commercial property insurance specialist to balance the insurer's financial interests with the policyholder's need for a fair and timely claims settlement, all while adhering to strict regulatory requirements. The presence of infestation by rodents introduces complexities related to the cause of loss, the extent of damage, and the potential for pre-existing conditions versus new damage, which can lead to disputes. Careful judgment is required to accurately assess the situation, determine coverage, and manage the claim process ethically and legally. The correct approach involves a thorough investigation that meticulously documents the extent of the damage directly attributable to the rodent infestation, distinguishing it from any pre-existing conditions or other causes of loss. This approach aligns with the regulatory framework's emphasis on fair claims handling, requiring insurers to conduct investigations promptly and thoroughly, and to settle claims in accordance with the policy terms and conditions. Ethically, it upholds the principle of acting in good faith towards the policyholder by seeking to understand and address the covered loss accurately. An approach that immediately denies coverage based solely on the presence of rodents, without a detailed investigation into the specific damage and its causal link to the infestation, fails to meet the regulatory obligation for a comprehensive claims investigation. This could be construed as a breach of good faith and fair dealing, potentially violating consumer protection regulations that mandate insurers to act reasonably and not to unreasonably deny claims. Another incorrect approach would be to offer a settlement that does not adequately reflect the full extent of the documented damage caused by the infestation, perhaps by undervaluing repairs or excluding legitimate costs. This would contravene the regulatory requirement for claims to be settled at their true value, as determined by the policy and the investigation, and could lead to accusations of unfair claims settlement practices. Furthermore, an approach that delays the investigation and settlement process unnecessarily, without valid justification, would violate regulatory expectations for prompt claims handling. Such delays can cause significant hardship to the policyholder and may be seen as an attempt to avoid or minimize the insurer's obligations. The professional decision-making process for similar situations should involve: 1. Acknowledging the claim and initiating a prompt investigation. 2. Gathering all relevant information, including policy terms, expert reports, e.g., pest control, structural engineers, and photographic evidence. 3. Analyzing the findings to determine the cause of loss, the extent of damage, and whether it is a covered peril under the policy. 4. Communicating clearly and transparently with the policyholder throughout the process. 5. Applying policy terms and regulatory requirements consistently and fairly to reach a settlement. Question 15. During the evaluation of a commercial property insurance policy utilizing a reporting form option, the insured expresses a desire to consistently report a significantly lower inventory value than their actual average inventory levels to reduce their premium payments. What is the most appropriate professional response for the insurance specialist? Option A. Inform the insured that the reporting form is a contract, and they can report any value they deem appropriate, without further elaboration on the implications. Option B. Agree to the insured's request to report a lower value, as the reporting form allows for flexibility in reported values to manage premium costs. Option C. Proceed with the policy as requested, assuming the insured understands the reporting form and its implications, without further discussion. Option D. Clearly explain the reporting form's requirement for accurate reporting of values and the potential consequences of underreporting, such as coinsurance penalties or adjusted losses based on the last reported value, advising the insured that consistent underreporting can lead to inadequate coverage. The correct answer is D. Clearly explain the reporting form's requirement for accurate reporting of values and the potential consequences of underreporting, such as coinsurance penalties or adjusted losses based on the last reported value, advising the insured that consistent underreporting can lead to inadequate coverage. Explanation. Scenario analysis. This scenario presents a professional challenge because the insured's desire to minimize immediate premium costs by underreporting values on a reporting form policy can lead to significant underinsurance and potential financial distress at the time of a loss. The specialist must balance the client's immediate financial concerns with the long-term implications of inadequate coverage and the insurer's contractual requirements. This requires a deep understanding of the reporting form's mechanics, the potential consequences of non-compliance, and the ethical duty to advise the client appropriately. Correct approach analysis. The correct approach involves clearly explaining to the insured the purpose and mechanics of the reporting form policy, specifically highlighting the requirement for accurate and timely reporting of values. This includes detailing the potential consequences of underreporting, such as the application of a coinsurance penalty or the insurer's right to adjust losses based on the last reported value, which could be substantially less than the actual value at risk. The specialist must emphasize that the reporting form is designed for fluctuating values, but it relies on the insured's good faith and accurate reporting to function as intended and provide adequate protection. This approach aligns with the duty of utmost good faith owed to both the insured and the insurer, ensuring the policy remains valid and the insured is adequately protected. It also adheres to regulatory requirements that mandate clear communication of policy terms and conditions, and the specialist's role as a trusted advisor. Incorrect approaches analysis. Accepting the insured's request to simply report a lower, arbitrary value without full disclosure of the implications is an incorrect approach. This failure constitutes a breach of the duty of utmost good faith and potentially violates regulations requiring accurate representation of risk, exposes the insured to significant financial risk, and could lead to claims disputes. Simply stating that the policy is a reporting form, and therefore the insured can report any value they choose, without further explanation or guidance, is also an incorrect approach. This demonstrates a lack of professional diligence and a failure to adequately advise the client on their responsibilities and the policy's limitations. It neglects the specialist's role in ensuring the client understands their coverage. Ignoring the insured's request and proceeding with the policy as if the lower reported value is acceptable without any discussion or clarification is another incorrect approach. This passive stance fails to address the potential misrepresentation and leaves the insured vulnerable. It also overlooks the specialist's responsibility to ensure the policy accurately reflects the risk and that the insured understands the terms. Professional reasoning. Professionals in this situation should adopt a consultative and educational approach. The decision-making process involves 1. Understanding the client's stated objective, minimizing premium. 2. Identifying the potential risks and consequences associated with the client's proposed action, underreporting. 3. Clearly communicating these risks and the policy's requirements to the client, referencing specific policy clauses and relevant regulatory principles regarding accurate reporting and utmost good faith. 4. Recommending a course of action that balances the client's objective with adequate coverage and compliance, such as exploring alternative policy structures if appropriate or emphasizing the importance of accurate reporting to avoid penalties. 5. Documenting all advice provided and the client's decisions. Question 16. Governance review demonstrates that a commercial property insurance client has recently acquired a subsidiary company. The client has not yet informed the insurer of this acquisition. The commercial property insurance specialist is aware that the subsidiary operates a significant manufacturing facility that would be covered under the main policy's business interruption clause if a covered peril occurred. What is the most appropriate immediate action for the specialist to take? Option A. Proactively recommend and facilitate the endorsement of the commercial property policy to include the newly acquired subsidiary. Option B. Recommend that the client review the subsidiary's existing insurance policies to ensure they provide adequate coverage. Option C. Inform the client that no endorsement is necessary as the subsidiary is now part of the existing corporate structure. Option D. Advise the client to wait until the next policy renewal to formally endorse the policy to include the subsidiary. Correct answer is D. Advise the client to wait until the next policy renewal to formally endorse the policy to include the subsidiary. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the commercial property insurance specialist to navigate the complexities of policy endorsements, specifically concerning the impact of business interruption coverage on a newly acquired subsidiary. The specialist must balance the client's immediate operational needs with the insurer's contractual obligations and regulatory requirements, ensuring accurate representation and avoiding potential coverage gaps or misinterpretations that could lead to significant financial and legal repercussions for both the insured and the insurer. The challenge lies in proactively identifying and addressing the coverage implications of a material change in the insured's business structure. Correct approach analysis. The correct approach involves proactively recommending and facilitating the endorsement of the commercial property policy to include the newly acquired subsidiary. This is right because it directly addresses the material change in risk exposure. Regulatory frameworks, such as those governing insurance contracts and fair dealing with customers, mandate that policy terms accurately reflect the insured circumstances. Failing to endorse the policy could lead to a denial of claims related to the subsidiary, leaving the client uninsured for a significant portion of their operations. Ethically, the specialist has a duty of care to advise the client on necessary policy adjustments to maintain adequate coverage. Incorrect approaches analysis. Recommending the client wait until the next policy renewal to address the subsidiary's coverage is incorrect because it creates a period of potential underinsurance. Insurance regulations often require prompt notification of material changes that affect risk. Delaying the endorsement exposes the client to significant financial risk if a claim arises during this uninsured period, and it could be viewed as a failure to provide adequate advice. Suggesting the subsidiary's existing insurance coverage is sufficient without a thorough review is incorrect. While the subsidiary may have its own insurance, it is the specialist's responsibility to ensure the primary commercial property policy accurately reflects the consolidated risk profile of the insured entity. Relying solely on the subsidiary's existing coverage without verifying its adequacy and alignment with the main policy's terms and conditions is a dereliction of professional duty and could lead to coverage disputes. Advising the client that no endorsement is necessary as the subsidiary is now part of the existing corporate structure is incorrect. A newly acquired subsidiary represents a new operational entity with its own assets, liabilities, and potential for business interruption. This change in the insured's operational footprint constitutes a material change in risk that typically requires formal notification and endorsement to the existing policy to ensure continued and accurate coverage. Professional reasoning. Professionals should adopt a proactive and client-centric approach. When a material change in the insured's business structure or operations is identified, the immediate professional response should be to assess the impact on existing insurance coverage. This involves understanding the policy terms, relevant regulations, and the nature of the change. The specialist should then communicate clearly with the client about the implications and recommend the necessary steps to ensure adequate protection, such as policy endorsements. This process prioritizes client well-being and adherence to regulatory and ethical standards. Question 17. The control framework reveals that a commercial property insurance specialist is reviewing a policy renewal for a warehouse storing non-hazardous goods. The insured has requested to maintain their current coverage. The specialist notes that the previous policy used the broad form. However, a recent site inspection report highlights an increased risk of wind damage due to the property's coastal location and an aging roof structure. Considering the potential for significant damage from wind, what is the most appropriate approach for the specialist to recommend regarding the causes of loss form? Option A. Recommend upgrading to the special form to ensure coverage for all potential perils, including those not explicitly listed in the broad form, given the increased wind risk. Option B. Recommend retaining the broad form, but advising the insured of the potential for uncovered wind damage claims due to the roof's condition and coastal location. Option C. Recommend upgrading to the special form, explaining to the insured that while it provides broader coverage, the increased wind risk necessitates this form for adequate protection, and discussing the premium implications. Option D. Recommend retaining the broad form, as the insured has requested to maintain current coverage and the warehouse stores non-hazardous goods. The correct answer is D. Recommend retaining the broad form, as the insured has requested to maintain current coverage and the warehouse stores non-hazardous goods. Explanation. The control framework reveals a common challenge in commercial property insurance: accurately applying the correct causes of loss form to a policy. This scenario is professionally challenging because the choice of form directly impacts coverage, potentially leading to significant financial implications for both the insured and the insurer if misapplied. A specialist must possess a deep understanding of the nuances between the basic, broad, and special forms, and how they align with the insured's specific property and risk profile, all within the bounds of regulatory compliance. The correct approach involves a thorough review of the insured's property, its location, the nature of its operations, and the potential perils it faces, then selecting the causes of loss form that most comprehensively and appropriately covers these risks as defined by the policy language and relevant regulations. This aligns with the regulatory duty of care to ensure policies are fit for purpose and meet the reasonable expectations of the insured, preventing underinsurance or coverage gaps. It also upholds the principle of utmost good faith by providing accurate and appropriate coverage. An incorrect approach that selects the basic form without a detailed risk assessment fails to meet the regulatory expectation of providing adequate coverage for common perils. This could lead to claims being denied for losses that a broader form would have covered, potentially violating consumer protection regulations designed to ensure fair treatment and adequate protection. Another incorrect approach that selects the special form for a property with minimal inherent risks and a low likelihood of catastrophic events, without a clear justification based on the insured's specific needs or requests, could lead to unnecessarily high premiums for the insured. This might be viewed as a failure to act in the insured's best interest and could be scrutinized under regulations promoting fair pricing and value for money. A further incorrect approach that relies solely on the insured's initial request for a specific form without independent verification of its suitability for the property's unique circumstances overlooks the specialist's professional responsibility. Insurers and their representatives have a duty to ensure the policy sold is appropriate, not just what the client initially asks for if that request is demonstrably inadequate or excessive for the risk. This can lead to regulatory action for misrepresentation or failure to provide adequate advice. Professionals should employ a decision-making framework that begins with a comprehensive understanding of the insured's property and operational risks. This involves a detailed underwriting review, considering the specific perils likely to affect the property. The next step is to match these identified risks with the coverage provided by each causes of loss form: basic, broad, special, referencing the policy language and any applicable regulatory guidance on policy adequacy. The specialist must then recommend the form that offers the most appropriate and cost-effective coverage, clearly communicating the scope of coverage and any exclusions to the insured. This process ensures compliance with regulatory requirements for policy suitability and fair dealing. Question 18. Comparative studies suggest that clients often seek insurance solutions that appear to offer immediate cost savings, even if these solutions may not provide optimal protection in the long term. A commercial property owner is undertaking a significant renovation of a warehouse, intending to increase its usable space and value considerably. They have requested a completed value form policy, believing it to be the most cost-effective option. As a commercial property insurance specialist, you have concerns that this form may lead to underinsurance given the projected increase in the property's value during the renovation. What is the most ethically and regulatorily sound approach? Option A. Strongly insist that the client must opt for the agreed value policy, overriding their initial request for the completed value form to protect yourself from potential future liability. Option B. Agree to issue the completed value form policy, but assure the client that it will likely be sufficient to cover their needs, downplaying the potential for underinsurance. Option C. Explain the potential risks of underinsurance with the completed value form due to the significant renovation and actively recommend and explain the benefits of an agreed value policy, which would better reflect the property's evolving value. Option D. Advise the client that the completed value form is their chosen option and proceed with issuing the policy as requested, as the client is the decision maker. The correct answer is D. Advise the client that the completed value form is their chosen option and proceed with issuing the policy as requested, as the client is the decision maker. Explanation. This scenario presents a professional challenge because it requires the insurance specialist to balance the client's stated desire for a specific insurance product with the specialist's fiduciary duty to ensure the client understands the implications and potential drawbacks of their chosen coverage, particularly when a more suitable alternative exists. The specialist must navigate the client's perception of cost saving versus the actual risk exposure. The correct approach involves clearly explaining the limitations of the completed value form option for a property undergoing significant renovation, and actively recommending the agreed value option as a more appropriate and ethically sound solution. This is justified by the regulatory framework's emphasis on providing accurate and comprehensive advice, ensuring clients are not underinsured, and acting in the client's best interest. The specialist has a duty to inform the client about the risks associated with the completed value form, such as potential underinsurance if the completed value significantly exceeds the initial estimate, and to present alternatives that better align with the property's evolving value and risk profile. This proactive disclosure and recommendation uphold the principles of good faith and fair dealing. An incorrect approach would be to simply process the client's request for the completed value form without further discussion or recommendation. This fails to meet the professional obligation to advise the client adequately and could lead to significant financial loss for the client if the property's value increases substantially during renovation, resulting in a claim payout insufficient to cover the actual cost of rebuilding or repair. This approach prioritizes expediency over client welfare and regulatory compliance. Another incorrect approach would be to strongly pressure the client into accepting the agreed value option without fully exploring their concerns or the specific details of their renovation plans. While the agreed value option may be superior, an overly aggressive sales tactic that disregards the client's input or perceived needs is unethical and can damage the professional relationship. It fails to demonstrate a collaborative and client-centric approach. A third incorrect approach would be to downplay the risks associated with the completed value form, assuring the client that it will likely be sufficient. This constitutes misrepresentation and a failure to disclose material facts, violating the duty of honesty and transparency. It exposes the client to unacceptable risk and breaches regulatory expectations for professional advice. The professional decision-making process for similar situations should involve a thorough needs analysis, clear communication of policy options and their implications, a candid discussion of risks and benefits, and a recommendation based on the client's best interests, supported by regulatory and ethical principles. The specialist should document all discussions and recommendations. Question 19. System analysis indicates a commercial property insurance policyholder has reported significant damage to their warehouse roof following a severe hailstorm. The policyholder believes their insurance will cover the full cost of repairs. The commercial property insurance specialist reviewing the claim must determine the extent of coverage. The specialist has access to the policy document and a detailed report of the hailstorm's impact. Which of the following approaches best ensures compliance with regulatory frameworks and ethical obligations in assessing this claim? Option A. Immediately deny the claim, citing that only catastrophic events are typically covered and that hailstorms are common occurrences. Option B. Focus solely on the client's description of the damage and their expectation of coverage without consulting the policy wording. Option C. Assume the policy covers all types of property damage, unless the client explicitly states otherwise during the initial claim report. Option D. Determine if the policy is an all-risk policy. If so, confirm that hailstorm damage is not specifically excluded. If it is a named peril policy, verify that hail is listed as a covered peril. Correct answer is D. Determine if the policy is an all-risk policy. If so, confirm that hailstorm damage is not specifically excluded. If it is a named peril policy, verify that hail is listed as a covered peril. Explanation. This scenario is professionally challenging because it requires the commercial property insurance specialist to accurately assess the scope of coverage based on the policy wording and the nature of the loss, directly impacting the client's financial recovery. The distinction between named peril and all-risk coverage is fundamental to policy interpretation and claims handling, necessitating a thorough understanding of policy definitions and exclusions. The correct approach involves meticulously reviewing the policy to determine if it is a named peril or all-risk policy. If it is a named peril policy, the specialist must verify if the specific cause of the damage is listed as a covered peril. If it is an all-risk policy, the specialist must then examine the policy's exclusions to ascertain if the cause of loss is specifically excluded. This approach aligns with the regulatory requirement to act with due skill, care, and diligence, ensuring that policyholders receive the coverage they are entitled to under the contract. It also upholds the ethical obligation to provide accurate advice in claims handling. An incorrect approach that assumes coverage without verifying the policy type and cause of loss is a failure to exercise due diligence. This could lead to a wrongful denial of a claim or an incorrect assessment of the claim's value, potentially breaching the insurance contract and violating regulatory standards for fair claims handling. Another incorrect approach, which is to automatically deny coverage for any damage not explicitly mentioned in a policy, misunderstands the fundamental difference between named peril and all-risk policies. This demonstrates a lack of understanding of insurance principles and regulatory expectations for policy interpretation. Finally, an incorrect approach that relies solely on the client's description of the loss without cross-referencing it against the policy terms and conditions is a failure to conduct a proper investigation. This can result in misinterpretations of coverage and potentially lead to disputes and regulatory scrutiny. The professional decision-making process for similar situations should involve a systematic review of the policy documents, a clear understanding of the loss event, and a diligent application of policy terms, conditions, and exclusions. This ensures that coverage decisions are well-founded, compliant with regulations, and ethically sound, protecting both the insurer and the insured. Question 20. Investigation of a commercial property insurance application for a manufacturing facility reveals significant potential for third-party injuries due to the nature of the production process and public access to certain areas. Which approach best integrates commercial general liability, CGL, considerations into the commercial property insurance placement? Option A. Advise the insured that standard commercial property insurance policies inherently exclude third-party liability, and no further action is required. Option B. Assume that the property's physical security measures will adequately mitigate any potential for third-party injury claims, rendering CGL considerations unnecessary. Option C. Offer a broad-form property damage endorsement that includes coverage for all third-party claims, without a detailed review of the specific CGL exposures. Option D. Recommend a standalone commercial general liability policy in addition to the commercial property insurance, ensuring clear communication of the distinct coverage scopes to the insured. The correct answer is D. Recommend a standalone commercial general liability policy in addition to the commercial property insurance, ensuring clear communication of the distinct coverage scopes to the insured. Explanation. This scenario presents a professional challenge due to the inherent complexity of integrating commercial general liability, CGL, coverage into a commercial property insurance policy, particularly when dealing with a business that operates in a high-risk environment. The challenge lies in accurately assessing and underwriting the potential for liability claims arising from the property's operations, which can be distinct from direct property damage. Careful judgment is required to ensure that the policy provides adequate protection for both the insured and the insurer, without creating unintended coverage gaps or imposing excessive premiums. The regulatory framework for commercial property insurance specialists mandates a thorough understanding of all potential exposures, including those that fall under CGL. The correct approach involves a comprehensive review of the insured's operations, a detailed assessment of potential third-party injury or property damage claims, and the appropriate application of CGL principles, either through a standalone CGL policy or an integrated endorsement. This approach is correct because it aligns with the specialist's duty to provide accurate and comprehensive insurance solutions. Regulatory guidelines emphasize the importance of understanding the full scope of risk associated with a commercial property and its operations. Failing to consider CGL exposures when underwriting commercial property insurance could lead to underinsurance, policy rescission, or regulatory sanctions for failing to meet professional standards of care. An incorrect approach would be to solely focus on the physical damage aspects of the property and disregard any potential for third-party liability claims. This is a regulatory failure because it neglects a fundamental component of commercial risk management that is often intertwined with property insurance. Another incorrect approach would be to assume that standard property policy exclusions automatically negate any CGL exposure, without a specific review of the operations and potential for such claims. This is an ethical failure as it demonstrates a lack of due diligence and a potential misrepresentation of coverage. A third incorrect approach would be to offer a CGL endorsement without understanding its specific terms, conditions, and limitations, leading to potential coverage disputes and reputational damage. Professionals should employ a decision-making framework that begins with a thorough risk assessment of the insured's business operations. This includes identifying all potential sources of liability. Subsequently, they must determine the most appropriate method for addressing these liabilities, whether through a separate CGL policy or an integrated solution, ensuring that all policy provisions are clearly understood and communicated to the client. This systematic process ensures compliance with regulatory requirements and upholds ethical obligations to provide sound insurance advice.